Welcome back to Factful Finance, the channel where we dive into the financial wisdom that helps you make smarter money moves. Now, I've got a question for you. Are you ready to keep more of the money you earn from YouTube? Because whether you're just starting out or you've been grinding on YouTube for a while, taxes are an inevitable part of the game. But with the right strategy, you can make them work for you, saving both time and money. In this second part of our YouTube Tax Tips series, we're going to break down some essential tax strategies every YouTuber needs to know, from understanding self-employment tax to maximizing your deductions. Stick with me, because if you take these tips seriously, you'll be setting yourself up for smoother tax seasons ahead. But before we dive in, let's keep it real. Tax rules for YouTubers can be complex, and every individual situation is different. So, while I'm providing some high-level tips, it's always a good idea to consult with a professional who can give you tailored advice. This video is for educational purposes only, and any product recommendations I mention don't imply endorsement. Now, with that out of the way, let's get into it. First things first, let's talk about taxes and how YouTubers get taxed. If you're earning money through YouTube, you're likely classified as a self-employed individual, which means you're responsible for paying both the employee and employer portions of Social Security and Medicare taxes. That's the self-employment tax, and it can take a big chunk out of your earnings if you're not prepared. Here's the thing. If you're making money on YouTube, you need to set aside money for your taxes, and you need to do it regularly. The IRS requires you to pay estimated quarterly taxes, meaning you're responsible for paying your taxes 4 times a year, rather than all at once in April. So, what can you do to avoid getting hit with a huge tax bill when it's time to file? One strategy is to create a tax savings account, where you automatically transfer a percentage of each payment you receive. Experts recommend setting aside at least 25 to 30% of your income for taxes, though this percentage can vary depending on your state taxes and whether you're eligible for any tax credits. Now, let's get into the nitty-gritty of tax deductions. As a YouTuber, there are a ton of expenses you can deduct to lower your taxable income. These deductions are vital. They can help reduce the amount you owe to the IRS. Here are some of the key expenses you should be aware of. 1. Equipment. Cameras, microphones, lights, and laptops. All of this can be written off. If you're buying gear specifically for your YouTube channel, it's fair game. Software. Subscriptions to editing software like Adobe Premiere, Canva for graphics, and tools like TubeBuddy or vidIQ for channel optimization can also be deducted. These tools are necessary to keep your channel running smoothly, so make sure you're not leaving these deductions on the table. 3. Home office. If you're filming or editing from home, you may qualify for a home office deduction. You'll need to use that space regularly and exclusively for business, but it can reduce your taxable income significantly. Number 4. Travel and meals. Are you attending YouTube conferences or collaborating with other creators? You can deduct travel expenses, including transportation, lodging, and meals, if they're directly related to your business. But here's something most people overlook: internet and phone bills. If you use these services for your business, a portion of your bill can be deducted. The key here is to keep detailed records of your business use versus personal use. All right, now let's get into the big question. Should you form an LLC or S-Corp? The answer depends on your earnings and long-term business goals. Forming an LLC can help protect your personal assets in case of any legal issues. But if you're earning a substantial income, forming an S-Corp might be beneficial for tax savings, especially if you're paying yourself a salary. This structure allows you to save on self-employment taxes by taking a portion of your income as distributions instead of salary, which is subject to lower tax rates. Now let's talk about the best tools for tracking all of this. One of the best ways to stay organized is by using accounting apps specifically designed for self-employed individuals. QuickBooks is a popular choice. It lets you track income, expenses, and even provides tax estimates. YNAB, You Need a Budget, is another solid app that helps you create a budget and track savings. If you prefer something simple and free, Excel can be a great tool to track your income and expenses. Just make sure you're consistently logging your transactions. So, how do you avoid tax penalties? It all comes down to planning ahead. File your quarterly estimated taxes on time and be proactive about saving for them. Also, consider hiring a professional accountant to help with filing, especially if you're forming an LLC or S-Corp, as there are additional requirements and filings involved. To wrap up, let's revisit those key tips. Set aside 25 to 30% of your income for taxes. Don't miss out on valuable tax write-offs. Your gear, software, office space, and more could be deductible. If you're earning serious income, consider forming an LLC or S-Corp for potential tax benefits. Use apps like QuickBooks or YNAB to track your finances and save for taxes. File your estimated taxes quarterly to avoid penalties. What's the first step you'll take to streamline your taxes and save more? Let me know in the comments below. If you found these tips helpful, don't forget to like, subscribe, and hit the bell icon so you won't miss out on more valuable financial advice. If you're looking for even more tips on how to manage your YouTube earnings, I think you'll enjoy the next video we've picked for you. Thanks for watching, and here's to making smarter money moves.